India's import of Russian crude expected to fall sharply in the month of December, reaching its lowest level in nearly 3 years. Refining and trade sources tell Reuters that buyers are scaling back to avoid violating tightening Western sanctions after volumes surged again in November. Meanwhile, Reliance Industries had confirmed last week that it had stopped purchasing oil from the two sanctioned Russian firms Rosneft and Lukoil ahead of the US sanctions and after honoring its contracts with the two oil companies. More details in this report.
India's Russian oil imports are set to hit their lowest level in at least 3 years in December. That's according to trade and refining sources. It would be down from multi-month highs seen in November. The sources said it's due to refiners turning to alternatives to avoid breaching Western sanctions. Britain, the EU and US have tightened sanctions on Moscow over the war in Ukraine. Washington's latest measures targeted top Russian producers, Rosneft and Lukoil. Buyers of Russian oil had until November the 21st to wind down dealings with the two firms. Separately, the EU has set a January the 21st deadline, after which it will decline fuel from refineries that handled Russian crude within 60 days of the bill landing. One source said that bank scrutiny following the latest US sanctions has made Indian state refiners extremely cautious, adding that India is likely to get 600,000 to 650,000 barrels per day of Russian oil in December. Most Indian refiners have stopped buying Russian oil. India is also under pressure to buy more US energy after Washington doubled tariffs on Indian imports to 50%, citing New Delhi's buying of Russian oil.
Staying with stories around trade between India and Russia, well, the India and the Russia-led EAEU group will start formal negotiations for a trade agreement from today. India and the five-nation grouping called the Eurasian Economic Union, or EAEU, had on August 20th inked the terms of reference for the agreement. Now, the terms of reference outline an 18-month work plan aimed at diversifying markets for Indian businesses, including MSMEs, farmers, as well as fishermen. Now, Russia, Armenia, Belarus, Kazakhstan and Kyrgyzstan are the 5 member countries of the EAEU bloc. Now, this development is important as India is looking to diversify its export markets due to high tariffs imposed by the United States. Russia is the top trading partner of India in that bloc, with bilateral trade worth $68.72 billion in the year 2024-25, with exports worth under $5 billion and imports almost close to $64 billion from Russia. But remember, the high import numbers are due to a jump in crude oil imports. But this data is last financial year's data. Now, the bilateral trade with Armenia, Belarus, Kazakhstan and Kyrgyzstan was much lower at just $830 million or so cumulatively between those 4 countries. Now, on the commencement of the FTA talks with Canada, Commerce and Industry Minister Piyush Goyal said there is serious interest on both sides in the agreement. He said that soon both India and Canada will meet to kickstart the process. In a free trade agreement, 2 countries either eliminate or significantly reduce import duties on the maximum number of goods traded between them. And staying on stories about India's GDP, well, India Ratings and Research, or INDRA, on Tuesday raised India's GDP growth projection for the current fiscal year to 7%, and this coming on the back of high growth in the June quarter and less impact of the US tariff hike on global growth and trade. Now, Indra expects GDP in FY26 to grow 7% year-on-year. That's 70 basis points higher than its earlier July forecast of 6.3%. Now, the RBI, meanwhile, has projected India's GDP growth in the current fiscal year at 6.8%, better than the 6.5% expansion in the last financial year. Now, India's real GDP grew at the fastest pace in 5 quarters at 7.8% in the April to June Q1 of this financial year. The official data for Q2 is scheduled to be released on Friday, November 28th. Now, major headwinds for India include the uncertain global scenario due to the US unilateral tariff hikes for all countries, with tariffs on India being among the highest at 50% announced in the end of August this year. But there are tailwinds too, and the tailwinds for the Indian economy since the July forecast are the faster than expected decline in inflation, increasing the real wage rate, especially in rural areas. And of course, another tailwind happens to be the GST rate rationalization. The ratings agency expects private final consumption expenditure to grow 7.4% year-on-year in FY26. That's 20 basis points higher than last year. And this would be driven again by GST rationalization as well as lower inflation. Now, Indian exports to the United States fell almost 12% and almost 9% year-on-year in the months of September and October this year, respectively. Now, while exports averaged $7.2 billion per month in the last financial year, FY25, they've averaged $7.4 billion from the April to October 2025 period, but dropped to a little under $6 billion during the September to October period this year.